It's Mark Zandi with us at Moody's.com. He's got whiplash over the headlines like we do as well. Mark, what are you going to think about? What are you going to write about this weekend?
Well, I guess the word for me is relief. I was very nervous about the jobs report, particularly in the context of recession fears. And I think given the better job numbers, given the increase in hours worked, given the rebound in wage growth, I think it's pretty clear that the economy is not in recession, and the odds of recession seem a little bit lower today than they did yesterday. The numbers are pretty good. Relief.
Bring up a Bill Gross relief note here. This is from Mr. Gross's note of earlier this week, late last week. But this one single sentence, I think, really captures the debate. Long-term profits cannot ultimately grow unless they are partnered with near equal benefits for labor. That's fascinating. Mark Zandi, do we need labor to get wage growth, or can we continue on with a lousy wage growth economy and yet corporates do so well?
Well, I agree with Bill that there needs to be shared returns. I mean, if you look at past business cycles, what normally happens is during recessions, businesses cut. They get their cost structures down, they get margins up, you get a little bit of sales growth, and you get a lot of earnings growth. And then businesses decide that those strong earnings, along with higher stock prices, are reasons to go out, expand, invest, and hire. And that job growth allows for income gains, and you get into the self-reinforcing economic expansion. So the benefits are shared more equally. In this business cycle, that hasn't happened yet, for a range of reasons, and that is a key reason for concern. Mm-hmm. We do need to see more hiring and ultimately more wage growth for this to be a self-sustaining economic expansion. So I would agree with his perspective on this.
Yeah. I skated with Dartmouth hockey yesterday, Mark, which was the first time since Nixon was president. Here's a chart that goes back to that time, back to the late 1960s. This is a shocking chart. We introduced it as a debate chart. There's the debate of 2000, the debate of the primary, rather, of 2008, and we roll over in our real household income. It is a $3,807 difference since 2008. That is remarkable. There's no mistaking it, Mark. We've got lower incomes.
Yeah, I mean, real median household income, so real meaning after inflation, median meaning households, half of households make more, half make less. Real median household income has essentially gone nowhere for a decade. And, obviously, that's testimonial to how tough the economy is and why people are very upset, nervous, anxious about what's going on. There's been really no progress in the growth in our standard of living. That's got to change. And so hopefully we will see the policy steps necessary to get the economy moving forward.
Mark Zandi, when we look at one of the series this week, ISM non-manufacturing, the payroll statistic, really quite abrupt. I spoke, folks, with Dennis Gartman earlier today, and he published in his note this idea of a really difficult manufacturing tone. I mean, the ISM survey, it's just done this, hasn't it, Mark? It's just rolled over, hasn't it?
Yeah, it has. Although, I have to say, Tom, I'm a bit surprised, given all the things that we've been going through and given the collapse in confidence that the economic data, including the ISM surveys, have held up as well as they have held up. So that gives me some encouragement, so that if in fact European policymakers do a few things right, if U.S. policymakers do a few things right over the next few months, I think confidence will reestablish itself, and the better fundamentals in the economy will begin to shine through. I think we have made a lot of progress righting the wrongs that got us into this mess, and you can't see that now given all the things that are going on around us. But if we are able to make our way through without going back into recession, policymakers do take a few right steps here. Those fundamentals will start. Those brighter fundamentals will start to shine through. Mark,
quickly here, and we're going to come back with you and Marc Chandler. Do you care about Europe this weekend? Can we say all clear in Europe?
I don't think you can say all clear about Europe for many years to come, Tom, unfortunately. I mean, I think the Europeans need to do a whole range of things. Some they need to do very, very quickly in the next few weeks, few months. I think they're moving in that direction. I think they'll get it roughly right. because I think it's now become pretty clear if they don't, that their economy is going to go into a deep recession and take us with them. So I'm hopeful they'll do it, but we need to see them follow through.
Marc Zandi of Moody's.com, and also Marc Chandler joining us of Brown Brothers Harriman. We've got to get to Europe. The news is happening right now, Marc, and then I want to come back to jobs. Victor, come on over here again, and you see euro plunging here. Does it surprise you to see credit markdowns for Spain and Italy and maybe Portugal?
No, I'd say that, we've seen Moody's earlier this week already had cut, we've already seen a lot of the rating agencies cut. Fitch is really the laggard. And so what surprises me really is that how fast we've come off here in the euro, which tells me that how fragile sentiment is. For the last couple of days we've been moving higher in the euro. Despite the stronger than expected jobs day today, the euro is still moving higher. Right. And now there's these latest downgrades, I think, is the shock to the market.
Marc, I was struck in my visit to Dartmouth yesterday how often the word confidence came up. I was absolutely thunderstruck about the focus was on a need for Washington rhetoric to boost confidence, whether it's in Europe or in Washington. How critical is confidence when you analyze GDP?
Tell you the truth, I really play down confidence.
Wait, there's two Marks. Marc, that's okay. Continue, Marc Chandler.
Yeah, sorry.
That was my fault. Marc.
Sorry, I just don't play a lot of emphasis on confidence because I think that's what's going on inside people's heads. What's going on inside people's heads is a reflection of what's going on outside of them. If you would tell me that unemployment remains sticky, stock market's weak, I'll say confidence is weak.
M-A-R-K. What do you think? Is confidence critical to GDP growth?
Yeah, I think it is. I mean, in most times, no. I think confidence reflects economic conditions, but there are times at turning points in the economy when the causality is reversed and confidence drives decisions in economic and GDP and economic growth. And this is one of those times, I think, because of things like the debt ceiling spectacle, the government shutdowns, especially what's going on in Europe and the policy mistakes in Europe. Confidence has been significantly hurt, and that is affecting consumer spending decisions, business investment decisions, and most importantly here in the United States, hiring decisions.
And Marc Chandler doesn't agree.
I think that here, despite the debt debate ceiling, despite the debt downgrade, third quarter U.S. GDP, it looks like 2.5%. So despite this lack of weakness, confidence, and weakness of these sentiment surveys, the U.S. economy is going to grow more in Q3 than it did in H1. So I'm not sure
it would have been 3.5%. And it would have been 3.5% to 4% without the confidence hit. I mean, I agree. The economic data has really held up measurably better than I would have expected at 2.5% to 3%. But it would have been a very good second half of the year if we didn't get nailed by these policy mistakes and the hit to confidence, in my view.
David Rosenberg with a note here, Gluskin chef, and I like this idea. He looks at the number of industries, and the number of industries today really weren't all that good. There was some real job losses there with some big moves in a few industries. There were still enough blemishes in each report to remain skeptical over the veracity of the jobs data. When you two look at this from two different worlds, Marc Chandler, let me go to you first on this. Within the foreign exchange market, does this change a dollar call when you see a decent jobs report?
No, I think that we're still looking at the U.S. dollar to strengthen here in the fourth quarter, finishing the year near 129 against the euro and say around 150 against the British pound.
Very good. Marc Zandi, the last word to you here. When you look at this jobs report today, will you change any part of your economic forecast when you see a sigh of relief report?
Yeah, I think I changed the balance of risk. So if you had asked me a day ago what the odds of recession were in the next 6-12 months, I'd say pretty close to even. Now I'd tack that back, maybe a 40% probability of recession. So still very high. Europe's a real problem. Foreclosure crisis, lots of things to worry about. Economy's still very fragile, but this makes me feel that the fundamentals are better than I had thought.
If you're long, you're in on a day or two trade. You're on your desk. You get hammered like that. When do you know to just throw in the towel and go to lunch?
Yeah, that's a good question. I think that really the problem is that most people have been short the euro as it's been falling. Look at the latest IMM commitment of traders, short 80,000 net speculative positions. So we thought that we'd get a short squeeze this week, and we got the short squeeze, but it looks like it's run out of steam. That in effect, what the market's telling me is that we're in a 130, 135 trading range. We tested the upside of that with the employment data, and now we've been rejecting the highs, and now we're coming back down, and we're stuck in that range still.
I mean, it's still coming down here. Let's do this chart. Victor Zanzi over there, he can't decide Jets or Patriots. Strong dollar, weaker exports. There's that range-bound DXY, and then we get the Chandler strong dollar. Is it sustainable?
We suspect it will be for the next several quarters, at least, partly because, as Mark Zandi was saying, the U.S. has some problems, but we suspect that European problems are much bigger and much more serious. Europe is having an existential problem, while we're just having a regular old deep problem. Sort of like you've got two things on your desk, urgent and important. What do you take care of first?
We got to start spelling alert. I can't spell existential. Okay, strong dollar, weaker exports. When does the dollar slam in and diminish NX?
Yeah, I think that even though, you're right, the dollar is stronger than it was, say, a week ago or 2 weeks ago, but the dollar is really, on the year, very little change against the euro. It's higher against some currencies, but we're not really seeing the dollar's strength as being a real inhibitor for further exports. In fact, exports are at record levels now, and trade has been a net positive for Q3 GDP.
Absolutely. Let's look at two charts here, folks. No, that's not the wrong chart. I want the other one there. I want the Greece chart. Chart number 9. How did that pop up? There it is. The scope and scale of the Greek crisis. We forget this chart. There's the complacency. That's when Chandler bought his island off of Mykonos. And then up we go. I mean, we forget. This is amazing, isn't it?
Yeah, I think that, the July 21st, the Europeans said that to get private sector participation, they got to take a 21% haircut, voluntary. Of course, to make sure it's voluntary. And now that they got 90% participation in that, it looks like several countries, perhaps led by Germany, is saying that 21% haircut's not enough. Many of the European banks reduced their holdings by 50%, sort of marked down, boosted their loan loss reserves. Some banks, including like, say, Dexia, which is in the spotlight this week, a couple of French banks didn't do that. They just cut it down to 21%. And so that's part of the strain on the financial system is they know they got to take a bigger haircut on Greek holdings.
I totally agree. This chart, folks, will be our lead chart for the debate. Let's bring it up here and get a Chandler analysis. The structural unemployment election. They're not going to talk about this Tuesday night. It's a third rail. Percent unemployed greater than 26 weeks. Way back in 1952 on the left, Henry Cabot Lodge, Ike, Harold Stassen, and then you've got Bush, and then you've got Obama. Well, they're all sort of bundled into a normal American range. Look where we are now. Mark, this American landscape, this economy, we've never seen this as we go to an election, have we?
I think we haven't seen this, and I think that before you were talking with Mark Zandi about about workers need to get more income so they can consume more. And I think this chart shows why that's not going to happen without some kind of positive force to let it happen.
Right.
That is, what did Franklin Roosevelt do? Sort of re-jumped or rekindled the labor movement. And I think that we're quite a ways away from doing that in the United States.
Right.
But this shows you, I think, that, and this is really Bernanke's point as well, the longer those people are unemployed, the more their skill set is not current.
And diminishes.
It diminishes and makes it more structural unemployment rather than just cyclical unemployment.
Mike, thank you so much for coming in. His book, The Myth of the Dollar.